The U.S. government developed the $2 trillion U.S. Coronavirus Aid, Relief, and Economic Security Act, better known as the CARES Act, to provide the resources needed to help fight COVID-19 and prevent a severe economic downturn. This broad-based economic relief and support impacts nearly all sectors of the economy. And today, we are joined by two friends of the Cleveland Leadership Center and dedicated civic leaders in Cleveland who will guide a discussion for us on how the CARES Act may impact you or your organization. I am happy to welcome and introduce our speakers from Gries Financial Partners, Ed Bell and Lauren Rich Fine. Ed is the president and has led the wealth management practice since 1994. Ed is a graduate of the Leadership Cleveland class of 2011. And in the community, Ed serves on the boards of Global Cleveland and Friends of Breakthrough Schools, as well as the Audit and Finance Committee of Cuyahoga Arts and Culture. Lauren Rich Fine is a partner at Gries Financial, where she joined the firm in 2016. Lauren is a graduate of the Leadership Cleveland class of 2007. And her classmates will notice I'll go ahead and point out the M&Ms behind you, Lauren. There you are. So her classmates will be happy to see that from 2007. And Lauren sits on the boards of the Chautauqua Foundation, the Cleveland International Film Festival, Cleveland Museum of Art, College Now, EW Scripps Company, IdeaStream, and MoCA Cleveland. Additionally, she is actively involved in a number of local startups. Gries Financial Partners provides investment and wealth management counsel and has been doing so since 1978. And as a final note, before I turn things over, please be aware that this conversation is meant to inform you, but is not financial advice. You are encouraged to seek guidance from your personal or organizational experts as needed. So thank you for joining us, Ed and Lauren. I'm really happy that you're here, and turn it over to you.
All right. Thanks, Bob. Thanks for the introduction. Thank you for everyone for carving some time out of your day to join us. One housekeeping note, you will have noticed on the invitation to today's presentation included Brent Horvath, one of our other partners. Sadly, his father passed away yesterday, so he is not going to be joining us. Unfortunately for all of the participants, he was the smart one in the group, so you're stuck with Lauren and I. So, we're here to talk about the CARES Act, and I'm sure that everyone on this call has been impacted in some way or another by COVID-19. But to give you to set some context of how quickly this all has come to pass, how quickly the CARES Act was put in place, the various responses. The national emergency declaration took place on March 13th, 2020. At that time, a number of states were issuing stay-at-home orders. Businesses were scaling back or shutting down. Employees were being laid off, furloughed. All sorts of things were happening very quickly. Both the federal government and the Federal Reserve jumped in rather dramatically to try and limit the impact, the negative impact on individuals, on businesses, on the markets, on the economy as a whole. They did so through the federal government's reaction took place through the CARES Act, the Coronavirus Aid, Relief, and Economic Security Act. And that was enacted into law on March 27th, 2020. So 14 days after the declaration of the national pandemic. So now the reason we talked about, or we titled this presentation, the ever-evolving CARES Act, is the fact that anything this massive, this dramatic, that was put in place that quickly was clearly going to need some tweaking as time went on, and that has been the case. So we'll talk a little bit about what happened initially, some of the follow-on, and where we stand now. That's both the federal government stepped in, as did the Federal Reserve, and we're not going to get into that, or Lauren may talk just a hair about that. But both organizations learned a lot from the 2008 Great Recession, and they followed some of the playbook developed there. So hopefully that has helped limit the damage. I mean, we've certainly seen some significant damage. We've all seen what happened to the stock market, the number of folks that are out of work, businesses that may or may not ever recover. But hopefully the work that the federal government and the Fed did will limit that long-term damage. Nick, you want to move forward? So as we said, the CARES Act was signed into law on March 27th. It was initially a $2 trillion stimulus package. That number, last I saw, is maybe north of $3 trillion. So it continues to evolve. The idea was to provide fast and direct economic assistance to individuals, to small businesses, large businesses, and to dampen the impact of the pandemic. So Nick, if you want to go forward. So there's really a number of different pieces to the act, some of which are more focused on individuals, some of which are more focused on businesses. On the business side, the targeted industry, there were some targeted industry supports that, such as the airline industry, was granted $50 billion in the way of support. The government's view was the airline industry is essential to the workings of our economy, and if it were to go away, the long-term devastation to that, not just to the airline industry, but to the economy as a whole, would be traumatic and pretty hard to recover from. So they were given $50 billion. Various restrictions were put in place. They were required to keep staff in place through the fall, mandated to maintain designated airline routes. Monies were not allowed to be utilized for excessive executive pay. Kind of a lesson that came out of 2008, some of the perceived abuses there. So that was the way some identified industries were addressed. For smaller industry or smaller businesses, Nick, if you want to move forward, one of the major approaches was the Paycheck Protection Program, PPP, and maybe a number of people on this call have partaken in this, applied for loans, received loans. But the idea was that small businesses were defined as businesses with fewer than 500 employees, could apply for loans up to $10 million, with the idea that the funds would be used to help cover payroll costs, trying to keep people employed, keep the money in the economy, in circulation, and the funds were to be used for payroll costs primarily. Up to 75% of it was to be used for payroll costs, but it could also be used for other matters, rent, benefits, and so forth. So it's a fully guaranteed loan by the federal government, has a maturity of 2 years, an interest rate of 1%, and the most attractive feature is the potential that it will be forgiven if it's determined that the loan proceeds were used for the purposes designated, the plan is to have those balances forgiven and the economy move forward. Now, the first tranche of that was just under $350 billion. That was gobbled up very quickly. And it turned out that there were some unintended loopholes in the plan. A number of larger companies that qualified by having less than 500 employees per site, per location, qualified, even though they were much larger companies as a whole, some public companies. And there was certainly some pushback. I'm sure most people heard about Shake Shack was one of the first companies identified. They got, and I forget what the number was, but say a $10 million loan, and they were, when all was said and done, they gave the funds back, and but still the monies went very quickly. Most of the businesses that it was intended for never got anything out of it, and there was certainly a lot of dissatisfaction with that. Second round came in after that was all gobbled up, of $310 billion, part of the evolution of the CARES Act. Congress came back and funded an additional $310 billion. And that hasn't been used up. The last number I heard was it was about 40% of that still available. There's been some speculation that some borrowers looked at it and thought that they weren't going to qualify for the forgiveness. Many businesses that had to shut down may have needed the money for rent payments that weren't that were still out there, but they didn't have the same workforce, so they weren't going to have 75% of it being used for payroll costs. So that is still the case. There is talk within Congress. In fact, comment by Senator Rubio of Florida was that this was really meant to be a loan program, and not meant to be a loan program, but a grant program, so that they may look to continue to tweak this so that the intended recipients are able to take advantage of it and stay in business. I should note that this applies, these funds are available to 501c3 organizations. There is, Lauren and I were just talking before we came on, there are a number of organizations, charitable organizations, that have gone back and forth as to whether they should borrow, should participate in the program. Some are concerned on a PR standpoint. Some are concerned with the logistics. Some are concerned with will they qualify for forgiveness. But know that that is available to 501c3s also. Nick, you want to move on? So the PPP program was a way to get dollars into people's pockets quickly, taxpayers, other individuals. One of the other ideas behind the CARES Act was getting it into the pockets of taxpayers, but leaving it there a little bit longer. So there are a number of provisions that have extended payment dates of taxes. And from a business standpoint, one of those relates to the employer portion of FICA payments. So for those of you that know, FICA is a combination of Social Security and Medicare taxes. Employees pay half of the tax bill, employers pay the other half. The CARES Act allowed employers to delay their portion of that FICA payment into the end of 2021 and 2022. And that also applies to self-employed individuals. So if you're a self-employed individual, you are also paying those payroll taxes. Half of them are, you're paying all of them, but you're allowed to now have that same deferral for one half of it, the portion that is considered the employer portion. So self-employed individuals should keep that in mind and look to take advantage of that also. Nick? So then there are a number of these benefits or provisions that apply that are geared towards individuals. We've listed 7 of them here. We'll talk about each of them in particular. Nick, if you want to go to the unemployment benefits. So clearly what has happened with all of this shutdown is we've got 30 million plus new people out of work. And so they're filing for unemployment. Unemployment has limited support, limited benefits, and the federal government recognized that those needed to be supported some. So part of the CARES Act, the federal government added an additional $600 per week to every beneficiary's unemployment benefit. And that benefit, that extension or addition will go for 4 months. Now I should say it probably will apply to the 4 months from when they start to receive benefits, because one of the things that has happened throughout this process is with this massive number of people filing for new unemployment benefits, the process has been a bit of a nightmare. A number of state systems have just not been able to handle that. They've been overwhelmed. So a number of these benefits may not have started yet or are just now starting. So that 4-month period would start as the benefits begin. The base coverage provided through the state unemployment programs was extended for an additional 13 weeks. And again, with with self-employed and independent contractors, typically it's been difficult for them to qualify for unemployment benefits. The CARES Act expands that coverage and should allow them to qualify for unemployment benefits. Nick? Again, a way to get dollars directly into the pockets of individuals was the stimulus checks. The government decided that they would pay to eligible recipients up to $1,200 per adult and up to $500 for every child under 17 in that household. Now, when I say eligible individuals, there's an earnings limitation on this. If to qualify for the entire benefit, you have to have earned $75,000 or less, $150,000 or less as a married couple, and the time frame is they look back at either the 2019 tax return or the 2018 tax return if you have not yet filed your 2019 tax return. And you're also eligible for it if you did not file a tax return. Now that gets a little more complicated. If you're on Social Security, that information is in the government system, so they theoretically should have all of that. But if you think you're eligible and you have not received a benefit, there is a website under the IRS's website, and the web address is there on the screen, where you can check the status of it and follow up if in fact you have not received anything and are eligible to. Nick? Another point of keeping dollars in people's pockets are for federal loans, federal-backed loans. There is a forbearance period. It's set for 180 days, although it can be extended for an additional 180 days. So basically, you can put your mortgage payments on hold for up to 1 year. It shouldn't affect your credit rate or your credit score. There shouldn't be any fees or interest charges associated with it. It's when the forbearance period is over, it can be paid back in a lump sum, added to the back end of the mortgage, or reset the amortization period. But you need to reach out to your lender to take advantage of this. If you've got a qualifying loan, really no downside to doing it. Maybe a little bit of a hassle to reach out, but it does hold off some of these payments for a year, and at a period when obviously that might be particularly important. Nick? So there's also another loan, federal student loans. Those are to be suspended. Payments in those are to be suspended through the end of September of this year. Again, it applies only to federal loans. Most student loans are federally backed, so most loans will qualify. If the payments have been made or were being made automatically, that was to have stopped. If payments were processed inadvertently, they can be refunded. If you are eligible for it and the loans are continuing to be paid, reach out to your loan servicer and take advantage of that. But that is in place until the end of September. There's also employers have the opportunity to make a $5,250 payment on employees' behalf towards their student loans. In the past, that would have been considered taxable income to the employee, but at least through the end of the year, that can be a tax-free contribution on behalf of the employer. So if you've got an employer that is so inclined, it might be something to take advantage of. Next one. And this is an area that we've dealt with a lot with our clients. A number of adjustments have been made to the retirement fund environment under the CARES Act. So typically, or prior to this, 401ks, if they allowed a loan provision, limited that loans to a maximum of $50,000. Under the CARES Act, that loan amount can be increased to $100,000. Now, it's dependent upon the terms of the plan. And so if there is no loan provision, or the loan provision is still at $50,000, the plan document needs to be amended, but that's a pretty simple process. So that is available to employers if they want to make that available to their employees. RMDs, required, go back, thank you. Required minimum distributions. So as most of you probably know, for older individuals, now once they've reached age 72, used to be age 70 and a half, but the Secure Act just a short time ago raised that to age 72. So at that point, when you reach that age, every year you're required to take a minimum distribution from the retirement account. It's calculated based on your life expectancy and has to be taken by the end of the year, taxable income to you, and every year that percentage goes up based as your life expectancy goes down. What this plan did, or what the act did, excuse me, was it suspended that requirement for, sorry about that, suspended the requirement for the balance of 2020. So you don't have to make a distribution this year. One of the thoughts behind that, as you make the determination, it's always nice to defer the payment of taxes. So if you defer the distribution, you defer the payment of the taxes. Now, some people believe that given this massive increase to the national debt and a national debt that was growing anyhow, that higher tax rates are probably in the offing, and which may be the case, may be exacerbated depending on what happens in the election in the fall. So people that are concerned about that may look at it and say, well, you're putting off a distribution this year, but you're putting it into a higher tax bracket. So a couple of things to look at as you make that determination. Before this suspension was put in place, a number of people had taken out had already taken out some or all of their RMD. In some cases, going back to distributions that took place February 1 forward, you will have the opportunity to return those funds to the IRA if it's done before July 15th with no tax implications. And then lastly, in this area, if you take distributions from your IRA or retirement accounts prior to the age of 59 and a half, there, with some exceptions, there has been a penalty. There's a 10% penalty, as well as the tax on those distributions. The Act waives that penalty if the funds are taken out for coronavirus-related distributions, and that's a pretty broad term. So a lot of things would likely fall under that. So the penalty is waived, and actually the taxes on the distribution can be spread out over a longer period of time too. So a lot of flexibility with that around the entire retirement fund environment. Nick? A couple of minor tweaks to charitable deductions. For those people that don't itemize, there is an allowable $300 above the line charitable contribution deduction. And then for those that do itemize, there are limitations on how much of a charitable deduction you can take against your adjusted gross income, limited by the adjusted gross income. Those limitations have been increased. So a little bit of encouragement to help out keep the charitable process underway. So, Nick? And then this is probably most people are aware of this. The filing dates and the payment dates of the various taxes have been extended. These are the federal dates, but most states have followed these same guidelines. So the April 15 date that we're all well aware of for filing and paying our taxes for 2019, that date was extended to July 15th. So not only to file the return, but to pay any 2019 balances due. Estimated payments, first two quarters payments would have been due April 15th and June 15th. Both of those filing dates and payment dates have been extended to July 15th. But the extension date for filing, the final extension date for filing the tax returns remains October 15th. If you get to July 15th and are not ready to file your return, you don't have all the documents for whatever reason, you do at that time have to file for the extension, request the extension. It's automatic, but you've got to request it. and that extension date remains October 15th, but don't forget to do that before the July 15th deadline. That does not extend the payment date for the 2019 balance due. That remains July 15th, even if you extend the filing date. Now, I say that there has at least been comments made, and it may have been off the cuff comments from the president, but they've talked about the possibility of even further extending those payment dates has at least been broached. I don't think that will happen. I've not seen anything that has shown any real likelihood, but know that possibility has been discussed. One more, Nick. And then lastly, this is just a little quirk for those of you who knew that to get through TSA, the upgraded ID, the real ID, the requirements to have that in place was October 1st of this year. The CARES Act extended that to October 1st of 2021, knowing that most of the DMVs have been closed for a while, so it made it even more difficult. So you got a little bit of a breather there. And then Nick, I think it's Lauren's turn.
Thank you. And I thank you, Ed. That was terrific. I'm going to go quickly so that I'm sure you have some questions for Ed. Basically, I just hope everybody's recovering from the whiplash that we've seen in the markets after a precipitous decline in March, followed by one of the fastest recoveries in April, although obviously not a full recovery. What made this really unusual, besides the speed of the decline and the improvement in April relative to the last few years, is that this tide did not lift all stocks. In fact, we've seen a greater disparity of performance among equities and other asset classes than experienced over the last few years. Just as an example, the S&P is down 10.7% year to date, but the Dow is down 16%. Growth stocks are almost flat for the year, but value's down 22%. NASDAQ's up almost 1%, and international's down 20 to 22%. We're seeing similar disparity among fixed income as well, with the U.S. Ag up 5%, U.S. corporates up less than 1%, and high yield down almost 9%. Ed made comments about the Fed. They have been supporting different asset classes in the market, and there's an expression you hear about "don't fight the Fed." I think this market is a perfect example of that. And so you can feel reasonably secure with corporate bond investments, some high yield, some agency securities, given that the Fed is buying in the market, open market, those particular issues. You know, stock prices and valuations typically reflect future cash flow or earnings expectations. And that's what's really led to the volatility in today's market, where no one has a clue how this is going to play out and how long it's going to take. There's heightened uncertainty globally, and that's unusual as well. Usually there's a safe haven or two. So not surprisingly, certain stocks are being bid up, like the FANG stocks that you hear about, which is Facebook, Apple, Netflix, Google, to name a few, because people know they're going to be around and they feel comfortable that those companies will continue to grow. They also dominate the S&P 500 and are really driving why the S&P is outperforming at this point. And as a group, technology stocks are mostly up. We always encourage taking a long-term view, but even then it's difficult to pick the winners and losers. Ed mentioned the airline industry. It'll survive, but it's not clear specifically which airlines will survive. The same could be said true of hospitality. There was a pretty good article about that in the journal just this morning. A lot is being written about how overvalued the market seems, and without knowing the course of COVID-19, the timing of the vaccine, or a sense of when economies will improve, it's really hard to have conviction about whether it's undervalued or overvalued. We've seen typical investor behavior where people are buying on the dips, but we're also seeing a limit as to how aggressive investors are being on buying on those dips. And so we think equities will continue to trade in a range. Low interest rates also provide support for stocks, as there really aren't a lot of alternatives right now. So overall, at Gries, we have been shifting our clients' portfolios more into active management away from index funds. We think it's going to be a very selective market where you're really going to want to pick which companies are going to survive and which ones aren't. But we're also dipping into international. We think the valuations merit it. We are being very selective as to which regions we want to take exposure to. And we're further diversifying by taking a position in value because the valuation disparity is just too great, and small caps as well. We don't have a lot of traditional fixed income exposure, but we do have fixed income oriented funds that we like that are focusing on generating income. The income returns in some of these funds, public and private, can be in the 5 to 8% range, which while there's still some risk to those returns, it's more comfortable to collect the income. It feels like more of a certain thing. And I would note that 5 to 8% isn't that dissimilar from what long-term equity returns have been. And for accredited and qualified investors, there's some pretty interesting opportunities with a lot of private funds in distressed debt, real estate, infrastructure, and private credit opportunities, again, with risk, but the returns that are expected more than compensate for that. So while everyone was caught flat-footed when the market cratered in March, you're always going to meet somebody who proudly will tell you they sold ahead of the decline and they're feeling pretty good. The problem with market timing is that you typically miss the beginning when the market returns, which are some of the best days, some of which we saw in April. And so those proud folks might or might not have gotten back in the market, which is typically the case when you try to time it. We're recommending that investors stay diversified, not make big changes to their asset allocation, but we are shifting, as I said, to more active managers. What we are doing is trying to anticipate what cash needs will be in the next year and possibly 2 years to make sure that we've got some liquidity on hand so that people aren't being forced to sell at the wrong time. But other than that, the big move is to just stay active in the market, watch it carefully, and if it's a protracted economic cycle, know that the market over time, just don't know how long, always does recover. And so with that, I'll turn it over to Bob, who's going to handle a Q&A. Thank you.
Yes, thanks, Lauren. Thanks, Ed. And anyone or those that are listening, if you would like to send a question either privately to me or in the chat box, please do. I do have a couple to get us going here that have come across chat. So related to the individual situations with the loan forbearance or the mortgage forbearance, is there any hardship that needs to be proven in claiming that or seeking that, or has the language in the, that with the financial institutions been written just loosely enough that it's simply a matter of reaching out and establishing that?
Yeah, good question. There is no requirements that you're in any particular dire financial straits or anything. It's an opportunity to take advantage of, and all it requires is reaching out and making the request.
A question came across, and perhaps this is more for our nonprofit partners, but many organizations have an endowment that in some cases it's restricted, and others it's unrestricted, but is there to generate interest income, and tapping into that endowment is something that is not advised. But at what point does that become a necessity where you have to balance the perception of that versus the need to simply stay afloat? Is there a tipping point, or is that something that is really just handled on a case-by-case basis for some organizations?
Ed, I'll jump in if you'd like. I think there's no one answer that can serve all organizations. It really depends. You have to be very sensitive about taking money out of endowment for these purposes because that wasn't typically the donor intent, and endowments are meant to be there in perpetuity. But if an organization is really on the precipice of decline, the endowment does them no good if they decline. And so it really comes down to the individual organization and how they were impacted. What I've seen a lot of nonprofits do is quietly go to some of their larger donors and look for extra gifts that are unrestricted that they can use to help them get through the next year, 2, or whatever it might take. And there's been good reception to that, depending, on how well they know their donors, because there's typically a lot of passion by the top donors for those organizations. But it is not just, it's not a good practice to take from your endowment, but you can structure it as a loan. You could structure it a lot of different ways, but it's a bad practice to get into for the most part.
Great. Thanks, Ed. Here's a question about the tuition reimbursement that employers, I think the threshold was $5,250 that you mentioned, and that is a not taxable benefit currently that an employer can offer one of their employees. Are there details about that? Would this come out of normal operating funds, or is that a loan employers can seek and then pass along? What are some of the mechanics of that?
No, it is a payment out of operations that they would elect to, essentially as part of compensating an individual, helping them along. It's obviously a different form, but it has a tax advantage as opposed to just an increase in compensation of $5,250.
Great, thank you. And this next question I'll read verbatim. These are coming across privately, so you're not actually seeing them in the chat box. As mentioned, the Fed said it would buy exchange-traded funds that track the corporate bond market. How are you thinking about this changing or not changing long-term investors' allocations of stocks and bonds?
It's not really changing how we're looking at it, because we're really looking at total return for our clients. Every client's goals or needs are very different, but for the most part, we're still thinking it pays to be very selective. And as I mentioned, while we wouldn't fight the Fed and we would rather be in areas that they're supporting, we're really looking for our fixed income opportunities from a cash flow and income perspective, and that's really guiding our investment selections.
Great. Well, thank you both so much. We appreciate your time and your expertise in sharing just a wrap up of the CARES Act and the implications and how that impacts us and some of the benefits out there. So really appreciate your time, and I'm going to turn it over to Marianne Crossley, our President and CEO at the Cleveland Leadership Center, who will wrap things up and give us a preview of some other programming happening this week. Marianne.
Thanks so much, Bob. And Lauren and Ed, thank you so very much for giving so generously of your time and expertise to help us as we try and figure out how do we navigate forward in all of this. Very much appreciated.